Hello, and thanks for joining us today. Welcome to GreenUp's quarterly market update for the third quarter of 2024. My name is Tony Schmidt, and I'm the CEO at GreenUp Wealth Management, and I am joined today by GreenUp's Chief Investment Officer, Daniel Grulich. Daniel, welcome. Thanks for joining us again today.
Thank you for having me, Tony. I'm excited to be here. We have a lot to cover.
Dan, we definitely do. And really, we're going to chat about a number of things today. But as always, we're going to take a step back and look at the market and just get a general overview. We're going to talk about this disconnect that's happening with the current interest rate cycle. The market is volatile, but it seems to be the new norm. So we're going to dig into that a bit today. And of course, we're going to open it up for some Q&A, for some questions that were presented to us by a number of our clients. So without further ado, let's go ahead and dig in, Dan.
Perfect. I am ready.
Great. So we're going to just dig in right away and talk about the 800-pound gorilla in the room, and that's inflation. Whether we're turning on TV, we're going to hear about inflation, or whether we're going to the grocery store, we're going to feel the impacts of inflation. So, Dan, talk to us a little bit about GreenUp's view on the current inflation trends.
Tony, this is something that we've been talking about since 2022, and it will be nice when we can start not leading off with inflation, which maybe we're getting close to, but will probably still be a hot topic for the next couple of quarters at least. The chart that you're seeing right in front of you is showing you all the different measurements of how we look at inflation. And it's a very key chart because if you look at the light blue diamonds, you're going to see the peak of the highest measurement that those inflation uh, items have reached in the last 12 months. And all of them are down from their peaks. In fact, Tony, we're starting to see inflation, and I'll use PCE, which is the Federal Reserve's favorite measurement. It's starting to get down towards the Fed's target of 2%. It's sitting at 2.2%. That is very much within reason where you'll start to see the Federal Reserve start to lower interest rates, which is what we've seen this quarter. In other words, we're starting to see a less restrictive environment, or borrowing costs are coming down, and that is very good for the economy.
Yeah, Dan, that's obviously a great trend. And I guess one of the things that jumps out in my mind is what could impact this trend that we're seeing in inflation? Because there's a lot going on in the world. Here recently, we've experienced the strike with the longshoremen. There's obviously, if we look at the global view with what's happening around the world, with wars and conflicts, what are some of these things that could really impact inflation?
And Tony, I think you're bringing up a good point, and I'll further it as well. When we talk about this growth being good at 2.2% or targeting 2%, I do want to just keep in mind that this is off of a 20 plus percent increase that we've seen over the last 2 years. So it's not like prices are going down, they're just increasing at a slower rate. And that's an important aspect because there's still a lot of stress on individuals. And when we look at the economy, the Federal Reserve is constantly trying to do a balancing act of if the economy is running too hot where jobs are very high, wages are at higher than inflation, and they're actually driving inflation, they're going to start to be worried and they're going to keep interest rates at a high point. But if the economy is just right and we start to see jobs slow down, which we've seen in the last 6 months, but not fall off a cliff and still be in a steady spot, the Fed's going to keep on their pace. And if things get really bad, they're going to speed up their interest rate cuts. So this is very much still a reactionary place where we sit, where we're looking at information that comes in. We're trying to figure out if it's good, bad, or indifferent, and we're moving forward. It kind of feels like Goldilocks, Tony, where it can't be too hot, it can't be too cold. It has to be just right. And luckily, that's where we've been sitting for the last about 12 months.
Well, Dan, let me pull on that thread for just a minute here as you're talking about the Fed and interest rate cuts. So we've started to see the Fed start to cut rates. What's GreenUp's outlook on Federal Reserve interest rate cuts?
We take the stance, Tony, don't fight the Fed. And it really means that the Fed is the ultimate arbiter of where rates are going. And as much as we may have opinions on where they are, we go by what the Federal Reserve tells us. So the chart that you're seeing in front of you is what's called the Federal Reserve dot plot. Really, what it does, it takes the opinions on where the Fed governors think rates will be in the short end. So this is affecting savings accounts, money markets, things like that in 2024, 2025, 2026, and so on. It's not exact, but what it shows is that throughout the next year, we should be expecting interest rates to drop by about 1.5%, roughly. And that's the path that the Fed is going to take us. If we're expecting interest rates to go down by 2 to 3% in that time period, we're probably a little bit ahead of the Fed, and our expectations are too high.
So Dan, let's bring this back home a little bit and how it's going to hit people living their life. How does this impact? And I'll look at two different sides of it. Folks that are either have a mortgage or are getting a mortgage, and folks on their savings rates.
So, and this is a great question because the bond market can be, unfortunately, Tony, so esoteric at times that people don't understand what it actually means. And we deal with this literally every day in our lives. So, if I'm going to boil it down to layman's terms, it means really two things. One, the Federal Reserve controls the short end of interest rates, which is really what your savings account, your money market, your checking account is at. And so, if you're not getting 4 to 5%, which is the current rate, the first thing is one, look towards a spot that is giving you 4 to 5% because you're losing out on free money. But the second piece is that you should be expecting that rate to go down by about 1 to 1.5% over the next year and continue to go down every year through 2027 because that is exactly what the Federal Reserve is doing. Now you may say, well, if all rates are coming down, we should see mortgage rates come down. Unfortunately, I don't think that will be the case. We will see them come down a bit, but mortgage rates sit more on the 10 and the 30-year end of the yield curve. And so when the market is doing really well, you do have the worry of inflation and inflationary pressures. And that does affect the 10 and the 30-year yield. So in other words, I don't think you're going to see the 30-year mortgage sit at 7%, but it's not getting back down to 3% most likely. We're probably going to settle in when rates go down to somewhere around 6 to 5% for mortgage rates. So you're going to see shorter term rates come down exactly by what the Federal Reserve says. Longer term rates like mortgages, they're going to be stickier and they're going to stay up a little bit higher. Honestly, more towards normal averages as opposed to what we've seen in the last 10 years.
So, Dan, let's continue down that path for just a moment. We're starting to hear that the bond market is becoming more normal. Explain to us what this normal means and how it impacts investors.
Is I think when you look at the bond market, Tony, people try to make it more difficult than it actually is. It's really common sense. If you lend me money, you would expect me to pay more interest for the longer that you lend it to me, correct?
Sure.
That's not where we are. If you lend me money today, the shorter time period that you lend me it, the more interest I have to pay. If I borrowed money for 10 years, Tony, I would pay you a lower interest rate than if I borrowed money for 30 days. That just does not make sense. And let me just say, that is what is happening in the yield curve right now. And when we talk about normalization, what you're going to find, and this is really the Federal Reserve's goal, is over the next about 24 months, they're going to bring those short term interest rates down below the longer term interest rates so that if you lend money to someone for a longer period of time, they're actually going to pay you more interest. And that makes more sense. And just as that's what we call a more normal yield curve. And it just is the market's getting back to common sense.
That's a great point. I think a great way to put it is common sense, but I don't think a lot of us really understand where that relation has been short versus long. So I appreciate you giving some additional insight there. And I'm going to pivot because we've covered inflation, interest rates, and the yield curve. However, let's take a look at the stock market. Okay. And Dan, we all know that corporate earnings drive the stock market over the long term. So, what is the state of corporate earnings and how is that really going to impact the market?
Corporate earnings are fantastic, Tony. If I could do a visualization, there would be balloons going up on the screen right now with where we are. We just came from a corporate earnings recession last year where earnings were negative, and now we've seen three straight quarters of positive corporate earnings. Not to mention, the next year's corporate earnings are expected to be actually, apologies, Tony, the next 3 years corporate earnings are expected to be in the mid to low teens from a growth standpoint. That is a very good market. And when you look at this particular chart, it's one of my favorites. You see the black line, which is showing you the S&P 500's performance or the 500 largest companies in the US. And then the blue shaded part is showing you the earnings of the S&P 500 during that same period. And if you notice, they are both in line. There may be time periods where they're disconnected, but the lines eventually meet each other, and that is because corporate earnings and the S&P 500 follow each other almost to a T directly. And when you're talking about mid to low earnings growth in the next couple of years, you should be expecting mid to low earnings in the S&P 500 over the next couple of years, and that is very exciting.
So, Dan, knowing this, how does GreenUp recommend uh, portfolios in this environment?
Now, the one thing that you have to be careful about is you can't just lean into the areas of growth because there's lots of different areas that we're seeing that are exhibiting growth, which is also one of the exciting areas to talk about. But what we focus on is diversification and over allocating into areas that are still low cost but are exhibiting earnings growth. So, yes, you'll see the large cap companies in the portfolio, you'll see large cap growth. We do not shy away from that. But you will also see mid cap investments or small cap investments, which also look just as good from an earnings standpoint, but are not as expensive. That diversification should really help us during this period where the S&P 500 earnings are spiking.
So there's a lot of positives that we're hearing, both on the rate of increase of inflation, what's happening with the yield curve, and also what corporate earnings are producing. What risks should investors be aware of as we're heading down the fourth quarter here in 2024?
And this is really, I think, the difficult piece for investors to, especially retail investors, to take into account. Because I am overly excited about the market, Tony. But there are some risks. And I think right now what we're seeing is the market, what I would term price to perfection. Or in other words, the expectations of what the market should be hitting are very, very, very high. And here's a perfect example of if you look at the Federal Reserve, we just told you that the Federal Reserve is telling us they're going to lower interest rates by 1 to 2 percentage points, by one, sorry, 1 to 1.5 percentage points in the next year. Well, the market is expecting the interest rates to go down a full 2 percentage points in that time period, if not more. It is ahead of where the Federal Reserve is right now, Tony. That's not necessarily a bad thing long term, but in the short term, that will probably cause some volatility. I mean, as does anytime we expect something to be really good and we get subpar expectation or results, right?
So, Dan, recognizing this, that there's this disconnect, slight disconnect on what the futures are saying and what the Fed's actually coming out to say. I guess what are some factors that could either speed up or slow down the Fed's rate or the rate that they're cutting?
And the Fed, that speed will be very dependent on the economy and where it's going. So a lot of people think it'll be with the stock market going up. That is not the case. The Fed actually does not care about the stock market. They care about two factors, inflation and employment. Right now, inflation seems to be under control, but if that starts to spike or it goes down substantially, those are two issues where you'll see the Fed maybe change policy. More importantly, Tony, I think they'll probably be looking at the employment market quite a bit. If the employment market is in a really good spot, but we're at 4.1% unemployment, where if you look 6 months ago, we were at 3.8% unemployment. So it has deteriorated slightly. And if that continues to get a little bit worse, I think you'll see the Federal Reserve speed things up and maybe even meet where the market is from an expectation standpoint. But I do want to be clear, the market is not always right here.
But Dan, we know that right at the center of the economy is the consumer. And if there's some things that Americans, we do a lot of great things very well, but if there's one thing that we continue to do well, it's spend money. So, talk to us a little bit about the consumer's spending trends.
Hmm. And again, before I go into the details, Tony, because I think it's important, the consumer is in a very good spot. And the reason we focus on the consumer is they make up about 68 to 70% of the growth that we see in the US economy. So it's something that's important to focus on. When we look at spending trends, you're going to see in the chart really two different measurements of what we call retail sales, which is the same thing or synonymous with spending trends for us. The bottom graph shows you ultimately how much spending has gone up in the last year. So we've seen an increase of 2% or 2.05% in our spending versus last year's numbers, Tony. That's good. Any positive spending is a good thing for the economy. But if you take into account inflation and how much goods have gone up in value, it's actually more like the top chart, which is negative 0.53%. So, although we're spending more money as consumers, we're not buying more things. And thus, inflation is still a very real worry that we have that could affect the consumer. And that's why you're going to see the Fed continue to focus on this. So, this may be a minute point, but it is a point that's important that we're seeing slight stress in the consumer that we're going to continue to focus on. And if that becomes a trend, Tony, we will act in the portfolios. It is not a trend right now.
That's a real interesting disconnect. And so you bring up the portfolios. Well, let's talk about where the rubber really hits the road. Because if I'm sure our clients and listeners today are thinking of in this manner. There's a lot of good information. Now we've talked about some of the risk, but what is GreenUp's forecast for the S&P at the end of 2024, which is right around the corner, and fast forwarding time a bit out to the end of 2025?
Tony, this is one of the areas that I'm okay being wrong on. When we started the year, I said that our forecast for the S&P 500 was 5,400. Depending on the day that you listen to this, it's about 5,700, 5,800 right now, with where we're sitting. That is a 22% increase year to date. That is fantastic. So we do believe we're going to keep those gains going through the rest of this year and into next year and actually accelerate. With the last 3 months of the year, we are not expecting massive gains at GreenUp because we've already gotten some pretty unbelievable gains. We are expecting the S&P to end the year at about 5,800 or so, which is currently plus or minus a couple percent where it sits today. Into 2025, we're expecting that to bump up to 64 to 6,500 or so. That's above, I believe it's a 15% increase from where it was in 2024. That is an above average year, Tony, for the market. That is a very good year to be an investor. And even though we've given some issues where you should be, I would say, not worried but cautious, you should still be expecting with that volatility a nice run up in the market. And there's a reason to want to be an equity investor.
And Dan, I think that's a great point and a good opportunity to transition a bit. And let's look at some of the risk and threats out there because if we look at the geopolitical environment, there's a number of conflicts going on around the world, and
Mm-hmm.
you know, as money managers, we have personal beliefs, but it's our job to put those personal beliefs on the sideline. And when it comes to making decisions in portfolios, to remain completely agnostic. However,
Mm-hmm.
let's dig in a bit. What are the key geopolitical situations, I'll call them, around the world? What are the risks that are ultimately influencing and can influence market sentiment overall?
So everything that we've just covered, Tony, whether it be retail sales or inflation or what the Federal Reserve is going to do or corporate earnings, they're all measurable. We look for trends. We want to see multiple indicators in a row that are going in a direction, right? It's a long-term analysis. What you've just described with what's been going on with Russia and Ukraine or the now Israel-Iran conflict that has expanded, you're talking about events that could really throw volatility in the market without us being able to know they're coming, for lack of better words. They're not measurable events. They're things that are idiosyncratic and they can cause volatility in the market. So the way I wanted to answer this question was more what are we going to do and what do we expect to see if something does happen negatively in Israel or in Ukraine. So the chart that you see is actually just showing you the number of 10% pullbacks in the S&P 500 by year from present day back to 1980. And if you notice, A 10% pullback is pretty common. Actually, on average, it happens 1.2 times every year. We haven't seen one, Tony, since 2023, and really the early parts of 2023. So we've gotten through 2023, gone through 2024 without one. We have a market that's not cheap, I would say, but is earning and it is worth its valuations. We have very fantastic inflation news that we've received over the last 12 months, where even though people may not feel good from a cost standpoint, I can tell you from an economic standpoint, it is much more in line with what the Fed was expecting than anyone would have projected. And you have these geopolitical conflicts that are still ongoing and some may argue expanding. It seems like you could be prone for a pullback if we get some news that the market doesn't like. And I think what's important for investors to understand is that 10% pullbacks are regular in the market. It is part of what you would experience if you decide to invest. And when that happens in a market that fundamentally is sound with positive earnings and increasing profit margins and a steady employment environment, you want to be a buyer of the dip. And so if that happens at GreenUp in every single portfolio where we're having equity exposure, we are going to look to buy the dip if we see a 10% correction, Tony. And that historically has been a very lucrative strategy, but we're not catching a falling knife. We are on firm ground because the economy is fundamentally in a good spot, and we're buying positions that are lower in cost that should be higher in cost into the future. So I'm not saying buy the dip in every circumstance, but I am saying buy the dip today if it happens.
Dan, I think that number is really staggering of 1.2. That number really jumps out at me of how frequent these 10% pullbacks really are. Wow.
Honestly, Tony, how lucky we've been to not really have a lot of volatility in the past couple of years. Outside, obviously, of 2022, we've had some pretty nice recoveries.
Yeah, absolutely. We truly have. It's been a great market. But as we know, pullbacks are going to happen. And I appreciate you sharing the information that GreenUp is rules based in our investment management. And we're not going to buy every time on the dip, but there's a data out there for us to make informed decisions so that we're not asleep at the wheel and we are equipping our clients to be as successful as possible.
Exactly.
So we've covered a lot of information today, ranging from we started inflation, we talked about opportunities in the market with corporate spending fueled by the consumer, and now we've looked at some potential risk out there. So let's pivot away for just a moment because a number of our clients submitted some questions. So let me start by thanking those individuals that submitted these questions. We recognize you're busy and to take time out of your busy schedule to submit questions for the good of the overall group, we greatly appreciate it. So I'll start with the first question because it really does tie into a number of things we've covered today. With money market rates being have been at a fantastic place, something we haven't seen in quite a while, but they're dropping, right? So with money market rates dropping, this client wants to know, should I invest in CDs or bonds to protect myself from falling rates, or should I stay in money markets?
That's a very good question. It would have been lucrative, Tony, to stay in money markets versus bonds over the last 12 to 24 months, roughly. I think the important thing is to realize that has changed, and it hasn't changed to where we feel there's more growth in the investment, or it's a lower value. Tony, it's changed because the people who actually set the money market rates have told you that the system is broken and they are actively looking to fix it. So whether we think the environment is going to push it one way or another, the Federal Reserve has come out here and said you will not be experiencing 5% money market rates in the next 12, 24, 36 months if inflation goes the route that they expect it to. So we know, for lack of better words, that that party is almost over and we're going to see rates come down. So it does make sense if you want to be an income investor and you want to take advantage of this really fantastic market with the highest interest rates we've seen in 40 years. I would start locking up your money strategically into things like bonds, CDs, treasury investments, something that will keep your rate locked in for a longer period of time so that when those money market rates do come down, you're still earning that higher interest rate. And it's a good time to start thinking about that or to start actually activating it and implementing a plan. Um, just for lack of better words, Tony, I expect money market rates to be about 2% in 2026 and 2027. And the hope is that you can lock in some bonds that are paying 4 to 5% today.
That's some great insight, Dan. And the thing I'd add is you mentioned plan. Each dollar that we have should be tied to specific goals and time horizons and things of that nature. So it's a great opportunity as the interest rate environment is changing to really work with your green up wealth advisor and chat about what's the right strategy for these dollars as well. So
I
this
couldn't agree
question
more.
so this question, Dan, is an interesting one. This is a pretty astute investor because they're talking about the yield curve. So a really interesting
Oh,
question, and it is somewhat in line with the last question as well. This individual wants to know how investors should approach bond investing given the current interest rate trends.
so I'm going to take a guess that this investor has not been pleased with their bond performance of the last 24 to 36 months. Because if you were in the Barclays aggregate bond index, this year was the first year in 3 years that you've had a positive year, and it's only up 3% right now. You actually saw 2 consecutive years of negative performance. I'll just say, Tony, that is not normal. Bonds work very differently from stocks, but when they're set and when they're set up, you know exactly what return you're getting if you hold them till maturity. You're not questioning, am I going to get 8, 9%? You know you're getting exactly what the yield is when you set it up. So, what I would say to that investor is that this sounds like more of an investment decision as part of an overall portfolio. And I would expect bond investments to continue to, I'm sorry, to start to perform better, more in line with where they have in the past. Think a 4 to 5% type of return is what you would expect. You should not be experiencing negative returns in bonds, at least for the next near term, let's say 1 to 2 years. And the reason behind that is interest rates are no longer going up. That is what has caused bond prices to come down because all of a sudden you could get a higher yield for new bonds. Now they're actively coming down as far as interest rates are concerned. So I guess, Tony, that was a long answer to say I expect bonds to go back to their boring selves of earning 3 to 5% per year. I do not expect them to be negative. I expect them to be something that decreases volatility in the portfolio. And I do believe we're in an environment where they'll start acting that way again. And it does make sense why that question popped up because we've had a pretty bad 2 years in a row of bonds.
There's no doubt, and that's a great answer. And let's let's all rally around the idea of bonds being boring again, right?
Exactly. It's a nice attribute to the portfolio.
So this question that was submitted goes to the complete opposite side of the gamut here. And it's right in line because heck, AI is something discussed at cocktail parties now. You can't get away from it. And it's a way of the future. And so this question is again around AI. And this client asked, AI seems to be the way of the future. I guess one, is it a good investment they want to know? And two, how should they be investing in AI?
So AI obviously is a very popular buzzword right now. And I would just tell you, Tony, I think of it more just from a technology standpoint. Technology expansion, making people more productive. But AI is just the current form. There are a couple things that I would think about with AI right now. The first thing is that we're in the very early innings of it. I know it doesn't feel that way because AI has been in the news, especially the financial news, for the past 2 to 3 years, as we've seen the recent expansion. But I would just say no, it's the early innings, and the with all the money flowing towards companies that have made AI, like Microsoft or Google, and those expanding, you have to think, Tony, that how are they going to legitimize their high stock prices? And the only way that would happen is if they're selling that AI technology to others, and others are benefiting from it substantially. So when I look at AI, I don't look at robots doing my dishes or cutting my grass or anything fantastic. I look at a system that can do administrative tasks very easily, that can communicate very easily. And every company in the US needs that. So The way we're playing it, yes, we have our large cap growth exposure with Microsoft and Google. We do like those companies, but that's not where I see the most growth in the next year. I actually see the most growth towards those companies that people would consider cheap or low cost, or some may call them value companies. You're going to see value companies do well, mid and small cap companies do well. Basically, the people that can use the AI tools or the technology to make their workforce more productive and have their profit margins increase by a couple percentage points. That is going to be a huge win. I mean, Tony, think about it this way. Although profit margins just may increase from 11 to 14 cents, let's say 3 cents, that's off of $25 trillion. That is a huge number. And mid and small cap companies will benefit from that just like large cap companies will. So that's how we're playing it. We have the large cap exposure, but we think that will trickle down to mid-sized companies and small companies that are not as expensive as large companies. And you're going to see those companies do very, very well as the economy continues to expand.
Dan, that's a great answer and great insight. We appreciate it, and thank you to the three clients that submitted those questions, and they really covered the gamut between short-term rates, the bond market on the whole, flowing all the way through to AI. So, thank you very much for taking your time and submitting those questions. Building on that, we just want to take a moment and thank all of our clients for the trust and commitment they put in us on a daily basis. The trust that you put in us is the reason we get up every day. It is our reason for being here. And it is an absolute honor and privilege to be your co pilot on your financial journey, and know that we truly value you as people, and we value your relationship as well. So, with that being said, on the behalf of the entire team at Green Up Wealth Management, Daniel Grulich, and myself, thank you for joining us today, and have a great rest of the day.